So let's look at fixed assets. Now, fixed assets or tangible assets result from capital expenditure being invested into a business which derive a multi-year benefit. Now, when you first bring your historical fixed assets balances into your financial model from your accounting package, these are brought into your historical balance sheet. As you can see in this example, we have three categories of fixed assets, those being land, buildings, and machinery and equipment. And on the right-hand side of the sheet here, we have our closing balances. So if we scroll across our time series until we have our closing month of June 22, we can see that we have a closing balance. And in the case of buildings, for example, we have a closing balance of 1571.4. Now, when you forecast your fixed asset balances, this is handled on your assets sheet and is located below your capital expenditure forecasts. Now, when we first look at your fixed assets analysis, you'll see at the top here, we're bringing in your capital expenditure forecasts, and it's bringing in these from our capital expenditure analysis above. Now, as we mentioned in our capital expenditure video, this is where we allocate our capital expenditure forecasts into our fixed assets categories. Now, looking at our categories, you can see here that we have all three being brought through: land, buildings, and machinery and equipment. And in the case of buildings, we have that opening balance of 1571.4 being brought through from our historical balance sheet. Now, when we look at our analysis, we can see that we have our opening balance. This is then increased by our capital expenditure that is allocated into our asset, in this case being 6.6 for our buildings fixed asset, and is then decreased by our book depreciation, which is being calculated. The sum of these then gives us our closing net book value, or the net written down value for our fixed asset at the end of the period. In the case of our buildings fixed asset, we have a closing net book value of 1573.6. Now, you'll see within our analysis we have two main assumptions. The first being our opening net book value term and our capital expenditure term. The opening net book value term represents the remaining average useful life of the opening book asset at the start of the forecast period. This being the period over which we will depreciate our opening balance, in this case of 1571.4. Our next assumption, the capital expenditure term, is the period of forecast capex depreciation, or the useful life of this capital expenditure. And it's important to note that we assume our capital expenditure occurs partway through the month for our depreciation calculations. The average age of our opening buildings fixed assets is 10 years, as our capital expenditure has a useful life of 40 and our opening net book value has a remaining life of 30 years, or currently has an age of 10. As a rule of thumb, you would generally expect your capital expenditure term to be greater than your opening net book value term, as your opening net book value represents the net written down value of your fixed asset. Now, by default, when we're looking at a depreciation calculation, we use a straight line depreciation method. This depreciation that we've calculated in the forecast month of July 22 of 4.4 is comprised of two components: the depreciation of our opening net book value of 1571.4 over its remaining useful life of 30 years, and the depreciation of our capital expenditure of 6.6 for the period over its remaining life of 40 years. If we look firstly at our opening net book value, this has a remaining average useful life of 30 years, or 360 months. So when we calculate the depreciation of this for the month of July 22, we take our opening balance and multiply that by 1 over 360 to represent this 1 month's depreciation out of the remaining 30 years. The next component of our 4.4 of depreciation is the depreciation of our capex. When calculating the depreciation component for our capital expenditure of the month, we multiply our 6.6 not by 1 on 480, but rather we multiply our 6.6 by half and then by 480, or multiply it by 960, as we assume that this capital expenditure occurred in the middle of the period rather than at the start of the period. If we then add these two components of our opening net book value depreciation and our capital expenditure depreciation, this then gives us our 4.4. Again, we have our opening net book value, which is then increased by the capital expenditure, decreased by our depreciation, then giving us our closing net book value at the end of the month. Now, when we look at the financial statement impacts of fixed assets within a three-way financial model, our fixed assets analysis hits all three statements. Our capital expenditure is an outflow on the investing section of our cash flow statement, decreasing change in cash held, and therefore decreasing our cash at bank. The calculated depreciation within the month is included on our income statement below EBITDA, decreasing our net profit after tax, and therefore decreasing the total equity on the balance sheet. Finally, the increase in our fixed assets is an increase in the non-current assets section of our balance sheet, increasing our non-current assets and netting out against our change in cash to have a decrease in our total assets overall. This decrease in total assets and decrease in net assets balances with our decrease in total equity to ensure that our balance sheet balances at all times. Hopping back to our example, if we look at buildings, we have capital expenditure of 6.6 and depreciation of 4.4, with the net of these being 2.2, which represents the change in our fixed assets balance in the month of July 22, going from 1571.4 to 1573.6. If we want to see these impacts on our financial statements within the model, we can head back to our table of contents and activate our financial statements. Firstly, looking at the income statement, if we expand our depreciation and amortization section, we can see if we look at our forecast depreciation section, with our middle category being buildings, if we scroll across our time series until our first forecast period of July 22, we can see that we have our forecast depreciation of 4.4. If we then scroll to our balance sheet and locate our non-current assets section and expand our fixed assets collapse rows, if If we look at our buildings, again in our forecast month of July 22, we can see that we have our closing balance of 1573.6. And finally, scrolling to the bottom of the sheet and locating our cash flow statement, if we expand our fixed assets capital expenditure, and at the bottom of this section we have our forecast fixed assets capital expenditure, we can then see that we have our 6.6 of capital expenditure included in the investing section of our cash flow statement. Now, fixed assets affects other areas of analysis within a full 3-year financial model. For example, if we have our capital expenditure of $100 but have not paid this balance entirely in cash, we would then adjust for this within our capital payables balance within the current liabilities section of our balance sheet. And if we have GST within our model, we would then need to account for the GST included on our capital expenditure. And finally, our depreciation has implications on the tax expense of the business from a corporate taxation perspective. Again, these considerations will all be handled within their own video. However, for the purposes of this video, when we're looking at the financial statement impacts of fixed assets within a full 3-year financial model, our capital expenditure is contained within our investing section of our cash flow statement, which decreases our change in cash held and decreases cash at bank. Our depreciation is included in our income statement, decreasing our net profit after tax and decreasing our total equity on the balance sheet. Finally, our movement in fixed assets is an increase in our non-current assets on our balance sheet. These movements ensure that our change in net assets reconciles with our change in total equity, ensuring that our balance sheet is balanced.